Hey guys, welcome back to the IGCSE accountant. In today's video, we're going to be looking into the next section under the topic business documents, which is sources and recording of financial data. So now, last class we did learn about, we had a brief discussion about an introduction into business documents, the types of business documents, the types of discounts that are applicable when each business document is issued. For now, we're going to be looking into two different types of business, two different sections, I would say, two different sections of business documents that can be used for two different types of transactions. So now we do have business documents out here. So now there are different business documents that we had learned. Let's have a quick look at those. We had 10 different types like invoice, debit note, credit note, statement of account, checks, check counterfile, receipts, paying in slips, bank statement, and petty cash vouchers. So now moving on, each of these business documents have a different use. So now let's look into those. So business documents are usually used for cash transactions or credit transactions. So you may be wondering, what is the difference between the two? So firstly, a cash transaction is when, for example, you have a customer and you have a business and the customer is buying goods from the business. So the customer pays immediately by bank or cash. For example, you go to a supermarket. When you go to a supermarket, you pay immediately. You don't have this option of, for example, you buy salt. You can't buy it on credit. You have to pay immediately. However, for example, you're buying an iPhone. These days, all phones have an EMI option where you can slowly pay back the amount, like how you pay back a bank loan with interest. You can slowly pay back the EMI on a monthly basis. So that is called credit because you're getting a good and you're paying back slowly, but the amount is higher because you're taking longer. So that is the difference between a cash transaction and a credit transaction. So firstly now we're going to be looking into credit transaction. Okay, so we do have a few business documents that we have for credit transactions. The first one is an invoice. I'm pretty sure most of you have heard your parents talk to their clients or their accountants that they have to issue an invoice or they have to receive an invoice. So an invoice is used as a record of a credit sale or a credit purchase. So record of credit sale or credit purchase. I'm just going to quickly explain the difference between credit sale and credit purchase. For example, there's a business and there's a customer. When the business sells something on credit, for example, you're buying an iPhone from the Apple store. When Apple is giving you the iPhone on credit and they're asking you to pay by EMI on a monthly basis, it is a credit sale for the business. But for you, it is a credit purchase because you're purchasing something from the Apple store on credit. So this is the difference between a credit sale and a credit purchase. So now, moving on, a supplier issues an invoice to the credit customer. The customer might refer to this as a purchase invoice. Okay, and the supplier may keep a copy of it, and that is called a sales invoice. So an entry is made in the books of accounts when an invoice is issued or received for the goods or services supplied or bought. So the customer enters the value. For example, whatever you buy on credit goes to two different journals. We did learn about the difference between bookkeeping, accounting, how the data is processed, and how it's turned into a financial statement by sourcing different information. So usually we also learned about journals. Journals are usually in this format where you have an entry and you have an amount here in the debit column, and you have an entry and you have an amount in the credit column. So this is how it usually is. So the customer enters the value in the purchase journal. So a credit purchase should always be entered in the purchase journal. So a purchase journal and sales journal both record credit transactions. Purchase journal records credit purchase, and credit sales records is recorded in the sales journal. Okay, so the invoice is for a non-current asset. Then the book of entry, original entry is a journal. So, for example, you can even issue an invoice for a non-current asset. So then it has to be put into the general journal. So what you have to make sure is that all these purchase journal and sales journal is only for current assets. For example, you buy a current asset, only then will it be in the purchase or a sales journal, because a lot of businesses, they do buy raw materials which they will be using up or consuming in less than a year. That's a current asset for them because it gets over in less than a year. So obviously when they purchase it on credit, it's entered in the purchase journal, and when the business sells to them on credit, it's recorded in the sales journal because they'll pay back within a year. However, when it comes to the sale or a purchase of credit sale or purchase of a non-current asset, then NCA is just an abbreviation of non-current asset. The book of original entry would be the general journal. So general journal is different from the purchase journal and sales journal. So now an invoice does have different details which you can learn from your textbook, but I'm just going to quickly explain them orally to you. I'm not going to write them down. It usually has the date of the transaction, details of the supplier, details of the customer, details of the goods or services, and the trade discount. For example, trade discount can never be entered in the journals when you make entries, only cash discount, which we learned here. We did learn that discounted amount is entered in the books of prime entry, for which we already discussed in the previous class. So I'm just going to skip that for now. A very important tip that I would like to give is that you might be required to complete an invoice. This will usually involve the calculation of percentages of an amount. So it's high time that you keep these small tips in your fingertips because they're very important to keep in mind, and they're just simple tricks that you can use to easily gain marks. So the next business document that businesses use is the first one is an invoice, and moving on to the second one is debit note and credit note. So we had already discussed about this a little bit in our previous sessions, but I'm just going to explain them in detail. So usually a debit note is issued by customer. Credit note is issued by supplier. So a credit customer issues a debit note to a supplier to request a reduction in the balance of an invoice. So a customer could ask for a reduction in the amount they have to pay due to reasons like damaged goods, or goods are missing, or even wrong goods that are being supplied by accident. Okay, so this is when a debit note does not assure that the customer will get back the money. They are just requesting the supplier if they can get back the amount because they have a reason for it. So no entries are recorded in the books of prime entry at this stage. This is because the supplier has not yet authorized the reduction. This is done when the customer receives a credit note. Only when a credit note is issued by a supplier, it means that it can be recorded in the books of prime entry. So a debit note usually has information which you can just go through from your textbook, but I'm just going to list them down, like the date of the request, details of the supplier, name, address, details of the customer and name, address, the reason for the request for deduction, and details of the goods that are being returned, details of the good that were being missed, or what kind of wrong goods were supplied, and the total reduction is being requested. So what is a credit note? A supplier issues a credit note to a credit customer when the balance on an invoice is reduced. So when the supplier understands that, okay, the goods that we had supplied to the customer has some fault, and it needs to be returned. So this is when the supplier understands and authorizes the return. So when a credit note is issued, the supplier can give back the customer need not pay that part of the amount. So now, like how we enter the details of a credit sale or credit purchase in a purchase journal or a sales journal, we have to enter these. This a supplier issues it usually when these occur. So these, in the sense when there's damaged goods or goods are missing or wrong goods are being supplied, this is when the supplier understands the issue and authorizes a return, which means that the supplier is ready to take back the goods which they had supplied to the customer, and they need not pay for it, the customer need not pay for it. So an entry is made in the books of prime entry when a credit note is issued or received. So for example, I'm purchasing to help you guys understand better. So we have a business and we have a customer. So when business sells on credit, what do they call it as? Credit sale. And when customer purchases it from the business, it's called a credit purchase, right? So same way we do have, for example, when the business gives back the goods, it's called purchase return for the customer, and for the business it's called a sales return, because they had sold something and they are the customer is returning it, and same way a customer is purchasing it and they are returning it, so it's a purchase return. So I hope you guys understood this. A credit note also has the date of reduction that is being made, the details of the supplier, name, address, details of the customer, name, address, reasons for the reduction, details of goods that are being returned, details of the goods that had gone missing, so anything. So one last business document is for credit transaction is statement of account. So a statement of account is used to show all transactions between customer and supplier within a given time frame. So a statement of account is issued on a regular basis by the supplier. This is because no new transactions have taken place. No entries are recorded in the books of prime entry when a statement of account is issued or received, and the customer can check the balance on the statement with the balance in their purchase ledger to make sure that there aren't any errors that are being made. So there is usually a balance column which shows the balance after each transaction, and the statement of account is written in the point of view of the supplier. So transactions which increase the customer's balance will be labeled as debit, and the transactions which decrease the customer's balance will be labeled as credit. So information that is there in a statement of account is the date of the statement issued, details of the supplier, name, address, details of the customer, name, address, opening balance, the date and amount of any purchases made by the customer. These will correspond to invoices that were issued if it's made on credit. The date and amount of any returns by the customer, these will correspond to credit notes that were issued. payments made by the customer, cash discounts received or given to the customer, and the closing balance. So this is what is usually given in the statement of account. So now we're done with credit transactions. Now we're going to be moving on to the cash transactions part. Something's wrong with my pen. Okay. Moving on. So we do have different business documents, a lot compared to credit. We do have a lot more for cash. I'm just going to list them down, quickly explain them so that you can remember them better instead of writing everything down. So the first one is receipts. So receipt is used as a record of payment. A supplier issues a receipt to a customer when they pay for goods using physical cash. So for example, you go to your nearby supermarket, you buy some chips and some drinks, and then when you bill it, the cashier, the biller gives you a receipt. So that is called a receipt. So sometimes a receipt is issued when the customer pays using money in their bank account, and I think these days we do have e-receipts. For example, we can also call it a bill. We do have e-receipts where it's sent to our messages or our email to reduce the wastage of paper. Next is check and counterfoil. Check and check counterfoil respectively. So a check is a form of payment. It is written by the customer and given to the supplier. Supplier will take the check they receive to the bank. They'll take it to the bank and deposits them into the business bank account. So the check will contain details of the customer's bank account, name of the supplier, the amount to be paid, the date on which the check is returned, the customer's signature. Why do we need a customer signature? That we're authorizing the payment to the supplier. So the bank will go, they will take money from your bank, put it into the bank of the supplier. And what is a check counterfoil? Check counterfoil is basically attached to the checkbook. You would have seen your parents having a checkbook like this, and they will have to fill in data all over here, the amount, their signature, and they will have a small part that is perforated over here, and they can just tear it and then they can keep it as a record of payment. For example, you maintain a cash book, or if it's a business will want to keep record of the same data, and it is a proof that the right amount has been paid on this date, to avoid any errors. Next, we also have petty cash vouchers. A petty cash voucher is a document used when paying for small valued purchases using petty cash. So this is usually done when a check would not be appropriate due to the low value. For example, you buy stationery worth $2 or $1. You can't put that in the cash book. For example, every day you have small expenses. For example, you have to buy a small cover, you have to buy staple pins. All those cannot be listed in the cash book when recording, because too many transactions can make it very confusing. So that's where this petty cash comes into place. It helps keep a record of all data, but in a more simpler way. Okay, moving on. The customer pays the supplier using money from the petty cash till. So the information from the vouchers is finally put into the petty cash book. Next, we do have pay-in slips. So pay-in slip is a document used when depositing cash or check into a bank account. So the pay-in slip is kept by the business as a record. And even counterfoil is a record. Okay, so the pay-in slip is kept by the business as a record of the deposit, and it contains information like total amount from cash, total amount from check, total amount being deposited, the date. You can also call it bank challan in many Asian countries. Now we have a few more small terms that we all use in our daily basis. Just gonna put them down here. We do have a bank statement. So a bank statement is regularly issued by the bank. Just gonna list that down. It details all the bank transactions within a given period. It shows money that comes in and goes out of the business. And a bank statement includes payments that are made through different kinds of payment methods like credit transfer, direct debit, or telephone transfer, standing order, and bank charges. So bank charges is, for example, you have account in a bank will also take up a small amount of money from your bank account for maintaining your bank, for assisting you in making transactions. The business gets some, I mean the bank gets some money from you. So what is a direct debit? Direct debit is like, for example, every month a direct debit is set by a person or business receiving the payments. The business that makes the payments needs to agree to the terms. So this is when automatic payments are being made. For example, we do have we do have these bank charges. For example, sometimes in 1 month you may make a lot of transactions, 1 month you may not make any transactions. So based on that, the amount of bank charges that you have to pay to the bank will differ. Next, we have standing order. Standing order is same payment. For example, we do have these pro versions in a lot of apps. For example, we do have Adobe. Adobe is Adobe Photoshop. So for every few months you have to pay the same amount and it's automatically taken from your account. We can even take another example like Amazon Prime. Every month the same amount is taken from your bank account by Amazon. So it's the fixed amount that is being taken. That is standing order. Next, we do have a summary of business documents for transactions, which I will be putting up in the next class. I hope you all liked this video and found it easy. This is a very simple topic, and I think in the future we will be getting into a lot more tougher topics, and we will be breaking them into simpler parts and trying to understand them better. So thank you for watching. Please do subscribe, share, and like this video. Your support is really necessary for me to grow in this field and continue uploading videos. Thank you, guys.